Hello and welcome to the Investor Master Series. My name is James Boyd. We got alongside with us Brent Moore's in the chat. We welcome him as well. We got many of you, AP 514, Eva, Josh, Don, Will, and many others. Welcome and good morning to all. So in this class, we really try to bring it all together. We're not talking about just technical analysis. We're not talking about just fundamental analysis. We're not talking about just options. We want to have a place where we can go, where we can kind of take all those individual pieces and bring it together. And actually, how do you combine it all? Okay, and so this is a nice nice webcast to actually go to bring it all together and practice it and actually get your questions answered. So just real quick as we're getting started, remember when we'll talk about stocks, we will talk about options as well and how that can complement potentially a stock portfolio. When we talk about options, remember that options carry a high level of risk, not suitable for all investors. The information here is provided for general informational purposes only. This webcast also talks about technical analysis, but there's other approaches that include some fundamental analysis, may assert some different views. And we talk about the fundamental analysis class. We have that class on Wednesday at 4. Check that out. And also remember, we will be using the Paid Money software application known as the desktop version. Investing involves risk, including loss of principal. And when we talk about options and short options, that is, remember, those short options can be assigned. We talked about that, I think last Thursday. What does that mean? Exercise and assignment, okay? So when we say assigned, that means the investor sold a call, sold a put, okay? And that could be assigned anytime up to expiration, regardless of the in-the-money amount. Because someone on the opposite side, they went long. They have the right to exercise, okay? Now, also remember as we get going, we like to talk about markets and sectors, just kind of set the table. We'll talk about some current positions that are expiring on Friday. And I really have a number of stocks I want to look at. Some will be kind of more, maybe potentially more income. Some will be more kind of growth. We're going to kind of show a little bit all in terms of stock and option trades here today. I want you to kind of pay specific attention how we kind of go through a routine and really kind of identify some opportunities. And really that's what we want to do. And also learning how to manage and becoming comfortable in managing a portfolio. So what I want to do here just real quick is let's just pull up just briefly the indexes. Let me maximize this so we can see this, bring it up. Now, I like to look at when I wake up, and sometimes it's not as early as it should be, but the biggest actually thing is I like to look at the indexes in list form, okay? We got volatility, S&P, NASDAQ, RUT. We got the 10-year. We're talking about the 10-year interest rate. We got the dollar, the 2-year rate, semiconductors, DJX, and CL. Now, if you're waking up before the official market open, you'd probably replace these with futures tickers. That way you can get a sense of where the market is, okay? Fine with that. You don't have to trade the futures, but that way you get an idea of where the market might potentially open. Kind of the biggest takeaway from today so far, you're seeing the NASDAQ, NDX kind of get a little pushback to the upside. We'll talk about that. When you look at volatility, down around 14, and we would like to say stay down. The last couple of weeks, we've seen that the VIX has kind of not been as much of an issue. Thank you very much, says many of you bullish investors. Russell down just 12 points, not a whole lot after yesterday's big move. And we see in the last 2 days, we see yields have been starting to drop. The dollar looking a little toppy or starting to pull back. That could be a tailwind for equities. And if you're going to look at, let's say, semi still down, Dow down about 0.4%, and crude just kind of hunkering right around the 70-ish level. So kind of the biggest takeaway for me is softening on the rates, helpful for probably consumers. Watch the retail stocks, okay? Or we could even say the retail area. If we say the retail area, we're also saying what sector? Semiconductors. Okay. No. Baited you into that, right? You're like, yeah. Semiconductor. No, discretionaries. Who's in discretionaries? Okay. So let me kind of bring up something just real quick. If we saw retail stocks break to the upside, we're probably going to see that when you look at consumer discretionaries, the retail space is an industry group inside the discretionary sector. So the investor would be asking themselves, man, could I buy the retail space, just the group itself? Could I buy a discretionary sector itself? Could I buy some of the components in that? That is a major takeaway. And so if we're seeing these rates starting to come down somewhat after a big move, I think many consumers would actually find that more confidence building, okay, and not rates rising. Now, and the rates steeply rising, not just rising, but kind of steeply rising. Now, when you look at the SPX, you're going to notice on this, zoom that over again. If we look at the SPX, now I know that you're thinking, geez, I wish I could go back 4 or 5 days ago and buy the dip. You only get a couple chances, right? So I know you're thinking, I wish I would have bought here. I wish I would have bought here. Those long lower shadows. And I'm going to tell you this again, and I told you this yesterday. On any pullback, it always takes guts to buy on the pullback. It never changes, okay? So, and when you get in, you do not know what's going to happen. And when you actually have experience or lack of experience, you're always risking on any entry, okay? So you kind of just, it would be good to kind of get used to that, of just saying, hey, on every entry, I'm going to take risk. And where do I want to take risk? Do you want to take risk when it's potentially lower, or do you want to take risk when it's potentially higher? Okay, and think of it like that. Now, we also had a moving average crossover, yesterday at the close or today, and we're seeing that crossover. So this, again, is just kind of showing more confirmation. 10 period moving average, green. 20 period moving average went green yesterday. Second confirmation, probably by the end of the day or today, getting across. Third form of confirmation. Now, notice we're up near the prior high. Yesterday, we faded off the top. Some of you might have profit took. I don't know who you are, but you could tell us if that was you. And what you're going to see is we're trying to take out that prior, this high and that high again. You're going to see that when you look at the SPX, it very, very much looks like really like a big bull flag. Now, if you're a portfolio manager and you said to the investor, hey, your portfolio that's equity based is up 10%, and they said, well, the S&P is up 25. Thanks a lot. Okay, I think. So you got to remember here, if this market breaks to the upside and you only have about a month left to go, there could be a little squeeze where investors start to chase performance, because at the end of the year, investors start to really see, what did my portfolio do for the year? Okay. And if we're comparing equity portfolios to, let's say, an equity portfolio, just because they were invested doesn't mean they got what the benchmark was. Do not forget this. Buying the benchmark or a product that tracks the benchmark is an option, okay? And we talk about that on Fridays. Now, the biggest thing is on the NASDAQ, we are seeing a cross there, okay? There. We'll come back to some of those stocks in just a moment. The Dow Jones itself kind of looks like an inside day. The cross happened yesterday as well. And Mr. Russell shot to the upside. Today, we're kind of getting a bounce near the 10-period moving average. All indexes look still pretty strong. It's nice, though, to see the NASDAQ come up with it as well. Briefly, when we actually take a look at, let's say, on the sectors, okay, as far as the sectors that are standing out, okay, and I'm not doing this just because you're here. I'm doing this because this is what I like to look at, okay? I like to go down just like what we're showing. So when we take a look at the indexes, I like to rank them by RS5 so I can kind of really see where that relative strength is. So if I kind of were to circle the areas that kind of have the relative strength and I look over to the left, you got real estate. I want to talk about two stocks in the real estate area here today. Financials, Staples. Hasn't seen that for a little bit. Don't be a staple hater, okay? We said before that some of those stocks, there's different reasons to own staple stocks outside. Yeah, and it's something, you're trying to have not everything be the same in a portfolio. Like if you said, all I buy is tech stocks. Well, what happens if tech stocks go down? It becomes more of a feast or famine type of situation in a portfolio. We like to kind of have a little mixture of probably 5 different sectors, some being growth, some being more income, okay? And you're going to see industrials, and there is your discretionaries. Those are the ones that are getting the strongest push on a relative strength basis. I also want to point out right behind that is IXU, utilities, okay? And that one is right on the cusp of taking out that prior high. When you look at the moving averages, a couple of them just doing moving average crosses there. And the other one I really want to point out is communication, excuse me. $ IXC, okay? Communications. Do not forget that one, okay? Now, if we were on our class on Friday, we would just pull up a list of products that are tracking those sectors and then dive into what's moving those areas. Want to show kind of what these look like a little bit. Discretionaries, we already know that. We're going to talk about one of those stocks in just a moment, okay? When we take also a look at the industrials, that kind of looks very much like the S&P 500. We're kind of seeing, we could look at this as, is this a hanging man? Or is this, for example, a hammer that's chiseling away this prior high? Meow, meow. Okay, we'll look at cat in just a second. When we also take a look at financials, you're going to see that this is also at a brand new high yesterday, and then a little check back to the moving average, getting a little bounce so far. Remember, with the Fed trying to cut the short-term interest rates, they are really trying to steepen the yield curve. And if you're in the financial space, that's what you want to have, is you want to borrow for less in the short term and lend longer term. If you're a financial company, that's what the dream is that you try to borrow for cheap or cheaper and lend for longer at a higher rate, and you try to make the differential in interest rate. That hasn't been the case as of lately, the last couple months, because the short-term rate and the long-term rate has been the same, okay? So this bombs away to the upside we've seen in financials is with the expectation that the Fed is going to drop the short-term rates and have that longer-term rate hold at the same level and maybe steepen even somewhat or raise. Keep an eye on that. When you also look at, let's say, this area, let's go to IXU, this utilities, that kind of very much looks like a U pattern on the right-hand side. We could even say maybe like a head and shoulder, head, and then maybe a flag back and then come back, and maybe it takes out the 831. Keep an eye on the utility space, okay? We will look at, let's say, the staples. What you're going to notice is staples also kind of being more of an example of a diagonal line of resistance breakout. Okay? And when you break out that diagonal line of resistance, you know, the old channel might become the first target, right? And these prior highs become potential levels of resistance. So when you see stocks really break a diagonal channel, most likely you are in a longer term flag, okay? There you go. So lots of sectors here look kind of interesting. Any questions on these sectors? Any sectors that I missed that you think we should bring up? So if you were to ask me, hey, is technology still strong? You're going to see in just a moment, there are some technology stocks that are still strong. Discretionaries, we're going to also say retail stocks. Keep an eye on those, obviously going into the major holidays. And then when you look at staples, financials, real estate, I said utilities, and communications, okay? Yeah, Fleeg. Okay, I appreciate that, Fleeg. Now, let's kind of go ahead and kind of talk about a position that we had from last week. You got it. Now, by the way, when you come to this class, I want to get you a real set. Think of it as like a routine that we're doing together, okay? And what I want to do is I want to go back and look at a past trade example that we talked about last week. And I want to go, and we practiced some examples of these shorter term types of trades. Now, we know that all of us are not the same. I have 4 kids, and they're not all the same, okay? they're not. And here's the deal. I want to go back and look at this SMCI for just a second, okay? This SMCI, we shorted the put. How do we know it's short? It says minus, okay? Days left, 3 days left. It was sold for 152. It's at 9 cents. So remember, when you're selling something, you're trying to sell when the price is high, and you're trying to buy back when it's as close to zero as possible. I do see some buffering, so I'll just kind of, I will watch that. Now, what you're going to notice is this trade was from last week to this week, okay? And what you're now going to notice is if I click on this, that trade was put on last week, and we only practiced one contract. Could have done more than that. But we are just kind of trying to show how this works. And SMCI is really still one that has pretty high implied volatility. Now, I would like to kind of show our first trade. Number one is we're going to right-click on this. Now, remember, if we said, well, I want a little bit more, okay? Well, the only thing you can make more is that 9 cents. Some might think, well, how about I just buy this back and then sell another one for next week and start with a bigger premium or a higher max gain? Well, that's the idea, okay? Now, what we're going to do is we're going to right-click on this, create closing order. We're going to buy it back. Now, when we buy it back, let's say we buy it back for 9 cents, that's going to include a commission, okay, because it's over a nickel. So we're paying back 9 cents of the initial credit plus the 65 cents. Now, this is not, I'm just closing the position. What we're then going to do is we're going to enter a new position. Now, calling all technicians. If we look at this trade, is this something maybe we should roll now? Or did the trade, for example, go to the target already and maybe we could just profit take and kind of wait for a second? Now, when are those earnings? Today. So the problem is, if we're trying to take advantage of volatility, that volatility, it's going to pop today. So you might be thinking, I'd like to kind of see if we could roll, right, maybe after the earnings. But let's kind of go back to this theme is, we're going to try to sell this for next week. We're going to go the 6th December, and I'm going to kind of play the role that I want to be more conservative. What does that even mean? Well, if we were selling those pets again, and we said, you know what, James, I want to sell farther down the strikes, okay? And if I said in a normal situation, we'd sell a strike that has a delta between 30 to 40, we're probably looking between here to here. But if I said, you know what, I want to kind of be I want to even be more conservative than that, but we need to verify that there's open interest, okay? Now, what I'm going to do in this case is, so you can change the strike that you're picking based upon what you think could happen. Now, if we have, for example, something like earnings today, there's more volatility. It's pumped up the option premiums. We're selling, and so that might be okay. But the biggest actually thing is we're also trying to obligate ourselves in the paper money account to be the buyer of the shares at 30. Now remember, this is for next week. Where's the stock now? It's at 34.5. Well, if we sell 30, how do we do that? We're going to click on that. We're going to do 2 contracts. Now, this is not a full position by any stretch of the imagination. If we had 200 shares, hence 2 contracts, $30, so it'll be $3,000 per contract, okay? If you did 2 of them, it'd be $6,000. We're probably talking about a third of a position. So I need you to understand this is not like taking a full position over the earnings. It fills. Good, because now we're looking to get back in. Now, when we also look at the premium, well, we got a $1.23 premium or $123. And that stock price is $34.75, okay? I call this the option yield. The option premium, $123, divide that by $34.75. And what it's really going to do is it's going to give us the option yield. It's 3.5%, but it's 3.5% for 10 days. The only way it can be that high is if the volatility is sky high. And it is. Now, let's kind of play the what if scenario, okay? So if we sell that and we're selling lower, the strike that we're picking is at, it's only at a 23 delta. If we look at the break even, now remember, we have not gotten filled yet and the price moved on us a little bit. Where do we say we're trying to get in? 124. That bid price is at 118. We're probably looking at 120. So we could look at this. We're at 121 now, and I'm going to try to get filled 121. I'm right close to the middle. Now, think about this. If the investor is on the hook to buy at 130 less, let's just say $1.20 for easy math, okay? It's going to give us a break even at $29.80. Say yes in the chat if you're with me. Okay? You with me? So we're selling the 30. Why so low? Well, we want to, for example, have a greater chance of grabbing the income, okay, and a lesser chance of really owning the shares of the stock. Now, when we looked at the option yield, $120 divided by the capital to buy, let's say, or I should say, if we bought 100 shares now, it's going to give us about a 3.5% yield. Okay. Now, many investors, they like to see maybe a 1.5 minimum, 2.5 would be average, 3.5 would be pretty high, but we know why it's high because that is so high. Okay. That doesn't mean it's better. It means it's forecasted to go up and down, hence greater risk. And that's why we're selling farther down. We still haven't gotten filled. We're going to come back, try one more time. Now be nice to this paid money count. We're going to go down to 116. Not a dramatic difference, but we're closer to the bid. And we're probably thinking that there's a pretty good chance we could get filled. Sold. And there she is. Finally gets filled. 116. Okay. Now, so we have a break even at 29. Okay. Break even at 29.80. Okay. So I like to look at two data points. What is the option yield? Now, what is option yield again? Just the option premium, what you sold it for, divided by the current stock price. So we could just take $1.20, which is what we were looking at initially, just to be constant, $34.92. And that's going to give us what I call the option yield, OY. Okay. Second data point I like to really see is if the stock is at 35 and the break even at expiration is at 29.80, I like to think about how much of a discount are we really potentially getting? Well, it's about $5.20. Type in the chat if you're with me, okay? So if we're at 35 and the break even expiration is at 29.80, how much of a discount are we getting? Well, it's $5.20. $5.20 divided into where the stock is now. Well, 520, okay? Divide by 35. It's a 14.8% discount from where we are now, okay? And that's the second point I like to look at is how much of a discount from where we are now. And so we're just looking at where the stock is now compared to what's the break-even expiration. What is that difference? That difference was about $5.20. $5.20 on the $35 stock. It's 15%. You're not going to see those numbers every day. You're not. And you're going to see that when you look at that, why is that the case? The daggum volatility is so high. Okay? So those are two numbers we need to know. Okay? Two numbers I need to know. What's the option yield and what's actually that discount? Okay? When we say discount, that does not necessarily mean you need to kind of think of the discount. We always talk about cash secured puts as the potential to buy the stock. Let's kind of further that comment. It's a potential to buy the stock at a discount from where it is now. Okay. Now that does not mean the stock is always going to go up. Example given. We have examples on NVIDIA as well, which is where we sold. That's losing right now. The 130 put, sold that too. That is winning a little bit because that one was the trade that was done earlier, okay? And you're going to see the Micron position, which we plan to buy potentially at expiration or earlier, that is down as well. So when we say discount, don't always take that as we're always going to win. Sometimes if those prices go down and the premium goes up, the option price goes up, we're going to be in a losing position, okay? The whole goal of this is we are trying to get the theta. That's number one. We're trying to get the theta decay. Number two, we're trying to get the volatility to drop. And if that volatility drops, it affects the option premium. And third, we are trying to get the stock to go up. We wouldn't think of putting on a bullish position without really kind of thinking, or a cash secured put position, if we were not bullish the stock, because these are positive delta trades. So if we have positive delta, the position could potentially benefit if we get the direction right. So with cash secured puts, we're trying to get the direction, the time, and the volatility. And if you can get the stock to go up, the time to go buy, and the volatility to go down, it's what we call the triple whammy. Okay? You get it all, potentially. And that'd be beautiful. Or if the stock went down, you're getting hurt mainly on about 2 out of 3 of those things. So it can go the opposite direction. Now, I want to kind of go back to, just real quick, a position. Let's talk about a different one. Second trade here. We talked about the IXY. And that IXY, what you're going to notice is there's 2 stocks in that space. If I were to ask you, consumer discretionaries, what stocks come to your mind when you think of something that's discretionary? Now, I'm going to go to the Market Watch for just a second. And what I'm going to do is I'm going to go down to, first off, let's bring up the Dow Jones Industrial. Let's see if we can't find something that is discretionary-ish in the Dow that might be giving us a little bounce setup and or breakout. Survey says, well, as we pull this up, what you're going to notice is kind of Amazon. Is that discretionary? Now, has anybody noticed, if you use Amazon or if you ever buy stuff, it used to be on Black Friday they had the deals. But now those deals started like days ago, and they're kind of being pretty aggressive to kind of sell some stuff. Okay, I don't know if you've seen that. But what you're going to notice is Amazon's getting a pretty decent bounce. There is also Apple as well. Okay, so what I want to do is let's kind of focus on these for just a moment. Now, by the way, if you're watching, for example, Caterpillar and also IBM, we're going to look at those as well. Okay, now let's kind of come to this, and we're going to speed her up a little bit. Now, when we look at Amazon, what you're seeing is on this chart, if we kind of said, are we seeing a confirmation? Well, the only thing we see on Amazon so far, and I don't want to say the only thing, is the shorter term moving average has gone from red to green. For some people that like to buy closer support, that is what they're looking for to trigger an entry. Now, what the investor might say is, you know what, James, I see the price above the 20-period moving average. The longer we stay above here, the more likely it becomes that moving average line becomes from red to green as well. Now, you hold up even longer, the moving averages can even cross. So right now, we're kind of very close to step 2 of 3, okay? Now, if I go back to the trade tab for just a moment, what I'm going to do is let's go back to the Amazon. Now, Amazon is not going to have the volatility that, let's say, SMCI has. Let's not kid ourselves, okay? What we're going to do is we're going to go to the 20 December expiration. Now, in this class, we try to, one of the strategies we try to focus on quite a bit is cash secured puts or short put verticals or long call verticals. We're trying to pick trades where we can get a bullish trade, have some time decay as well, okay? And trying to put that on our side, time. Now, what I'm going to do is, if we were, let's say, kind of more in that picking a strike with a delta of 30 to 40, it would really be, let's say, the 200 strike or the 202.5. Now, which one kind of has the open interest? It's really going to be the 200. The bid-ask spread, 275 by 279. And what we're going to do here is if I we're going to right-click on that. You'll see why in just a moment. We're going to go sell. We're going to go to where it says vertical. Now, why are we going to do vertical? Well, it's a $206 stock, right? A $206 stock, if we were assigned to buy the shares, well, what does that mean? Well, we buy 100 shares at 200. We buy 100 shares at $200 a piece. That's $20,000. Some people might say, I don't want to set aside that much capital to do the position. And so what we're going to do is we're going to come down to a strike on the put side with a delta 10 or less where there is open interest. And what we're going to do is we're going to just buy a downside pat. Now, con about that, it gives back some of the credit. Con about that, it also adds to the debit. However, when you kind of look at the cons and you evaluate the pros, the pro about it is instead of setting aside nearly $20,000, the investor's putting aside $2,250 because this really becomes like a short, wide put spread. Now, so that's what it is. But really in our mind, what is this? This is really nothing more than a cash secured put with downside protection. Okay. Now, the other thing kind of goes back to last week, we saw the carnage. And I think my wife must have heard the lesson from last week. And I think my wife must have literally seen my X account where she saw the wife laughing and the husband not so much about she was just pulling up to Target. Because on Friday, she went to Target and bought stuff for the grandkids. Not a recommendation, by the way. Now, the biggest actually thing is Target completely collapsed down. And we made the comment, hey, is this kind of indicative of the whole space, or are other companies beating up and gaining on Target's mishaps or misfortunes? Well, it doesn't look like Walmart. Okay, it looks like it's doing roll up, not roll back pricing. When you look at Costco, and have me in your thoughts. Tomorrow I got to go there for a little turkey items. Not a recommendation, by the way. And that hit the new high on what? Friday. Okay. Yesterday sold off a little bit, but still holding right at the 964. Not at the target yet. And if you went back and let's say, is Amazon getting in on this as well? Today's pop was a pretty good pop. I mean, if you went to bed last night at 2:01 and you just woke up, like let's say someone I might know, or someone near you as well, you wake up and the stock's $5 higher from yesterday's close to the current price. That's a pretty good way to wake up. Not saying it always happens. It could go down. But so just keep in mind that Amazon, Costco, Walmart, etc., they're maybe kind of taking advantage of, let's say, Target's misfortunes or misplanning, okay, or mismanagement. And sometimes it can be the managers that actually just make bad decisions. I know it's shocking. Now, I want to bring up just real quick, kitty cat, okay? Meow, meow. Now, why have we been watching this stock? Well, because the IXI, what you're going to notice is when you look at the IXI, when we pull up the IXI, what you're going to see is that's the sector. What type of pattern is this? What type of pattern? Now, we're going to come back to Apple in just a sec. Don't feel like we're not going to. We will. But it went down, and it went down pretty quick, but it also went up pretty quick. Now, when we see that type of pattern where the down move and the up move are symmetrical, okay, think about it in terms of time that is. It's symmetrical in terms of the time dropping. Okay, let's say it went down 6 days, and in 6 days it went up. That's a classic V pattern. Significance, what is it? Well, it probably stands a pretty good chance to take out that upside. If investors bought it up as fast as they sold it off, someone thought there was an opportunity. Someone with capital, or people, persons, entities, institutions, and so on, someone actually thought that might have been the opportunity to get in. Now, longer term, when you take a really look at this, we kind of really have some diagonal support. Now, I need you to say the word diagonal. Okay, diagonal. And those higher lows really become, well, points along a diagonal support line. Now, one of the stocks that we've talked about that has shot to the upside, okay, you're going to see John Deere has exploded. Now, let's say the investor didn't have that. And they said, what stock sometimes kind of moves in line with that? Maybe. Now, Caterpillar, okay, might be one of the stocks if we're talking about machinery, okay? Now, what you're going to notice is kitty cat. closed above yesterday. Notice where today's intraday low was. Where was it? Right at the midsection. How many times have we talked about that midsection? I can't talk about it anymore. Do you get it now? So if you feel like yesterday I missed it, I'm always late. Well, so many times the very next day or the next day after that, you'll see them come back down to the middle. Now, what does that mean? What does that mean in terms of the price? The price is going to show that it's down and it's red. If it's down and if the candle is red, it doesn't mean bearish. It just means the stock is down for the day. If you go down to the middle of the previous day's candle, some investors try to buy at the midsection of that. That's all I'm going to say for the 599th time for the month. And then we'll start over next month. Now, what we're going to do is we're going to buy the shares of the stock. Okay? Buy custom with OCO bracket. Okay? Now, wait, is this a stock trade or an option trade? Well, expiration, strike, stock, all the way down. It's a stock trade. Now, let's say the investor said, James, I have, let's say, $7,000. That is my position size. Fine. I'm going to click on this and actually just kind of right above that dollar sign, click it. Now, if you said, I didn't see that dollar sign, well, you got to click on the pool balls, percent, click on it again. This is going to position size based upon a capital amount that you specify. How much do you want to invest dollar-wise? Right above that, you're going to see the little chain. And if you click the chain, it snaps that down below and it says you're really buying 17 shares of stock. Now, what I'm going to do is I'm going to set the stop underneath yesterday's low point, which was the open. 399.97, less 2%. We're going to set a stop right at 391.97. I'm going to put it right there, 391.97. Where do we get that? It's right underneath yesterday's low, less 2%. Naresh says, didn't we do a stock trade on Caterpillar yesterday? Naresh, you have too good of a memory. I was planning that Naresh would not have that good of a memory. Naresh, stop that. This is called adding to a position. Now, data GTC. Naresh, I'm having a little fun with you. Someone has to. Now, what you're going to notice is this channel width, okay? We're going to go back and look at this. That channel width from there to there, okay? What do we got, like 400? This would be adding 22 to about 400. And if we kind of put that right there about a target, we're going to put about a 422 threshold. Do I know it's going to go to 422? Absolutely not. I have not a clue. Statistically, we could see what those odds are for a certain duration of time, and we could just do that by going to, let's say, the option table. We could go to what's called probability of touching. So if we kind of, now, by the way, there's not going to be a 422, there's not going to be a 422 strike price. We got a 420, 425. What's the probability of touching 420 by the 20th of December? As of right now, given the time and the volatility, about 56%. 425, probably touching that, 44-ish%. We kind of took somewhere right in the middle. It's high 40-ish%, which is saying it's almost a 50-50 shot of whether it can really touch the 422. Okay, we're buying the stock trade with a stop and a target. Confirm send, fire in the hole. Now, if you take a look at this, read what is in red to confirm that. This morning, feel free to laugh at me. I thought I was buying this stock, but actually I bought more shares of the other stock, which turned out to be okay. But I'm just going to tell you, even if you do this a lot, you could sometimes just take it a little fast. We're all guilty. So going through this and saying buy $7,000 of CAT at this price, reading it out loud, okay? Not that you talk to yourself, but it'll be a good thing if you did on this, just to verify, is this really what you want to do? We're going to send that order, and I'll fix that. So we're adding to the position on Caterpillar, and we're wondering, could that stock be kind of getting out of this little pocket of consolidation? Now, the other thing I want to do is go back to something just real quick. When you look at Apple, Apple also at the same time has kind of like a horizontal resistance, and there's been some higher lows on kind of two different angles. And we really have this big flag. Now, I want to get to two more trades. And so what you're now going to notice is we're kind of getting into the apex of this triangle. Now, what we're going to do on this one is we're going to say, look, I want to have a higher potential gain. What we're going to do in this case is we're going to right click on the 235, buy, and we're going to do a vertical, but we're going to make the vertical $10 wide. So we're buying the 235, and then what we're doing in this case is we are selling a higher strike. When we sell the higher strike, it's helping push down somewhat of the debit. We bought the call by itself, $460. But if we sell something to collective premium, it's pushing down the net debit. And we can see what the net debit is there. Why do we care about the debit? Well, the debit is going to change the break even. And now what you're going to notice is, in this case, we're buying. We have a right to buy at 235, but we also, for example, have a debit of 356. And so that's going to give us a break even at 238.56. So you need to kind of think, well, how much does the stock need to go up to break even? Answer, about $3.70. Okay. Now let me go back to this. Let me just bring that up right in that paper money account. Go back to that. And I just want to make sure that it's right in that IRA that we've been trading out of. By the way, we're 1 year into our trading here. We reset the account last year. We're going to go buy. I'm just putting it back in the paper money account. Same trade we saw before, but in the paper money, there it is. 235, 245. When you look at what's the potential max loss, well, we see in this case that whatever the debit is, that's what the max loss is. So if we could risk, let's say, $1,000, we would be doing 3 contracts. If we get the stock to close above the 245 at expiration, 648. Now that's per contract. We're going to pump this to 3 contracts because when you did 3 contracts, it would be right at that $1,000 level. Now, Soma says, why are we buying Apple near resistance? Okay, it's a question. And if we look at this, what you're going to notice is this is the second time. 1 time, 2 time, 3 time. So let me ask you a question. Let me spin the question back. Why would someone buy something at resistance? Why do they do that? Why do they buy something at resistance? Well, if someone's thinking that the underlying support, okay, the underlying support is increasing, they're thinking the wall of resistance might not necessarily become or stay resistance. Now, how could you kind of see some speculation that other investors are thinking that maybe the resistance might not be the resistance anymore? Well, number one is it might be, let's say, volume on the stock. Yeah, I would think, though, that probably the volume, and we've done this before. This is not the first time that we look at this and we look at volume and we look at open interest. Okay? So something that we're going to be wanting to watch is, do we start seeing in the shorter term high option volume relative to open interest? And we've talked about that a lot. If we start to see that, okay, and there's a couple of these strikes that are looking pretty active, 10% there, about 30% there. If you kind of start to see that, especially in the weekly options, okay, and if you look at these weekly options, this is what we saw before in NVIDIA. I mean, volume, this is so far relative to the open interest. Look at the volume there compared to the open interest. Volumes there compared to the open interest. This is kind of reeking. It's reeking of speculation that maybe there could be a short-term price move. And it's not just on the call side on 1 or 2 strikes. It's on a couple of them. It's not just on the call side. It's on the put side. And we're seeing that's 100% of open interest. That's 4 times the open interest. This is 4 times the open interest. People say, I look for volume. I look for volume. I look for volume. Well, volume kind of tells you about something about maybe are people willing to put trades on at key technical areas of support and resistance. The more volume we see relative to the open interest, at key levels of support, in this case, resistance, it's kind of leading us to think someone's speculating that, or people, investors, traders, someone's speculating that this might not be resistance for much longer. Now, if you get the discretionary sector to go up, and Apple kind of has 1 foot in discretionary, 1 foot in technology, well, and that sector goes to the upside, and people are trying to get exposure to the sector, they might buy some of the key stocks in the sector. Now, the other thing is, they might also be thinking, look, I'm trading it for the longer term trend, not just for what's happening in the short term. Understood. They're also thinking that maybe could this be a squeeze of the breakout of the ascending triangle? Okay. Now, here's what happens. People say things like, well, I'm going to wait until it breaks out. And then, hey, did they get in on the breakout? No, they were just saying that. Now, here's the deal. If you really stinking mean it, fine. But if you said, no, I'm just saying that because I like to not do anything, then you got to ask yourself, what's really your goal? Okay, what's your goal? Now, I'm telling you, we've all been there. Like, I was thinking I was going to do this. If this happened, I didn't do it. Got to have a plan. So our plan is, in the paper money account, is we're buying ahead of the breakout. We're seeing the speculation in the volume on those options. Now, we don't know if it's going to break out, but we're kind of trading the trend. We're trading the pattern and the price and the volume. Oh my gosh. Did it go by that fast again? I hate 45 minutes. Okay, we need more. Now, the biggest thing is we're out of time here. We did a number of trade examples. Keep an eye on SMCI earnings today. We talked about Apple, Amazon, and Kitty Cat. Meow. Look and see, can Cat start to trail more closely to John Big Deer? Now, I'm out of my time here today. If you have not subscribed to the Trader Talks channel, I don't know what you're waiting for. Click the subscribe button right on YouTube, Trader Talks with Schwab Coaching. You can get all of our content right on your mobile device, and it's right there, right in the palm of your hand, not just your computer. Just coming up next, we'll have Barbara Armstrong with Getting Started with Options. Thank you, Brent Moores, for being here as well and answering those questions. And also remember, with what we discussed, it was done for example, illustrative purposes only. Let's see if that discretionary sector can continue to get a little bit of a push. Now, remember with what we talked about, all investing involves risk. This is a class on Investor Master Series. Stay tuned for Barbara coming up next. And if I miss you tomorrow, happy Thanksgiving to you. Take care. Bye-bye.
All right, you're clear, JB.